Hello to all the year 10 students. This is your commercial studies coverage during this COVID break. The topic 10 basic principles of financial management. You can find the topic on your textbook page 5 and 6 and on the website for Quicken, a financial software available on the internet. So the 10 basic principles. First one is organizing your finance. This is the first step towards having an organized finance and towards creating your wealth. First one is to keep track of all your accounts. Organizing your finance enable you to be aware of your current status, your bank account balances, your loan account balances, and you're able to aware of all the detail about all the financial accounts that you have by keeping track on all of them. And next, if you have to check your mode of payment, all the expenses that we are making, all the payments of debts, all the saving accounts that we are keeping, all the modes of payment. The best way is to make them automatically being paid or being deducted into those payments or spending or savings. Then the last one is to create short-term and long-term goals. So once you have that in place, you have now achieved your first task, is to organize your finance. Is to spend less than you earn. This is basically means to have a saving. Your income should be more than expenses when you prepare your budget. Once you follow that strictly, it will help you keep your expenditure down. When you overspend, you are walking the opposite direction to this principle. This principle wants you to spend less than you earn, therefore you should spend less than the one that you budgeted. There are some software or apps that are there will help you keep track of your spending and make sure you keep on spending less than you are. However, there is a rule for some financial advisor. They have this 50-30-20 rule. This is not following what you have learned in our commerce, whereby in our lesson we divide the expenditure into fixed expenses and variable expenses. However, this divides the expenditure into two, needs and wants. And the rule is the needs supposed to be 50%, the wants is 30%, and saving is 20%. By following this rule, you strictly have a saving. So, and therefore it controls the amount of expenditure that you have to fit into the needs and wants. Sometimes our wants is much more than the needs. So this rule trim off the wants and make sure you have 20% saving. Unlike the other rule where whatever is left, that's the amount that you save. However, this one here has a fixed amount of saving, and you can trim off the other two, needs and wants. There's a motivation here. Spending less than you earn has got a psychological impact there, where you are motivated to use this rule to spend less because you have a long-term goal. In spending less, you delay the satisfaction of buying the needs and wants that you want today. In other words, you delay gratification psychologically, because you know there is something in the long term that is more rewarding, more satisfying, more lasting pleasure you get from spending, from delaying your spending in order to satisfy the long-term goal. That will allow you, with this motivation, will allow you to spend less today. So you are spending less today because there is a motivation behind it. You have a long-term goal, and you know that that goal is more rewarding than spending today. Then this principle will apply. You will be able to spend less, and you'll be able to cut down on the unnecessary ones. And I feel this rule is much more relevant because it divides up the expenditure into needs and wants rather than fixed expenditure and variable expenditure. However, for your exam, you follow the what you have covered, that is to divide it up into fixed expenditure and variable expenditure. This is just another dimension of looking at our expenditure. Next principle is putting your money to work. Putting your money to work is another way of saying investment. Now, at the bottom right hand side, you'll see saving means to put your money to rest, and investing means to put your money to work. So, saving is a place where you keep your money temporarily and then you put them into investment, put them to work. And it says that always look for opportunity for growth. In other words, always look for opportunity to put your money and make it grow in an account or in an investment account or whichever choice that you make. Take advantage of the time value of money from early age. Those people who invest early have the advantages of a long-term investment, and there's something that accumulates by itself. It's called a compound interest, where the money that you put in accumulates itself. So over a long period of time, the money can grow more compared to a short period of time. So from an early age, it has the chance of increasing more compared to investing very late. There's a list given there, ranking of best passive income streams, and that have been extracted from the financialsummary.com. And you can make a research on where to put your money so that it can grow. Building strong values of saving and investment from early age. And this will allow you to put sufficient money aside for emergency, that's from the saving, and later enter into investment once you have the emergency fund in place. The fourth principle is limit debt to income producing assets. This means if you have to take a loan, make sure it is on something that will produce income. So always think of spending on income generating goods or project rather than incurring consumer expenses. So if you have to take a loan, make sure it's for something that will generate income or generate wealth, and not on consumer goods. For example, debt on education. So once you graduate, you are most likely to have a better job. So that debt is worth it if you take education, a loan on education. Or real estate. Normally the value of house increases. So taking the risk of buying a house is more rewarding than buying a consumer goods. So the fourth there is limit debt to income producing assets. Now some of the income producing assets are listed there, number 1 to 14. You can see that it's being extracted from the internet. The fifth principle is continuously educate yourself. Keeping yourself updated on financial activities is a secret recipe for progress and growth. Knowledge is a valuable weapon in any business, thus understanding the purpose of investment and then executing the plan with, with perfection is essential. So it is proper that you keep reading financial news, make yourself aware of what's happening in the financial world, especially on investment and how the economy is functioning, government budget, and what's happening in our global market. So it's best that you do know the things that are happening and educate yourself on the best way to be aware of the risks that is involved in the investment that you make. Next is to understand the risk. Uncertainty or risk is involved in any investment. The key factor is to understand the risk in the field of your investment. The greater understanding one has on the risk, the lower the losses. For example, farms were destroyed by the cyclone and floods early this year. Yet 6 months later, these farms are thriving with healthy and fresh vegetable for the market. Farmers understand the risk associated with farming and the location of their farms. However, they also appreciate ways of benefiting from this risk. Usually, the higher the risk, the greater the reward. Next, diversification is not just for investment. There is a saying that says, do not put all your eggs in one basket. It means that you must invest in other avenues. You should have more than one investment account. So you should be able to look for creative ways to maximize your income. On the top right hand side, you have 8 income streams. So you should not only have only one, but more than one. Using your enterprising skills and your talents to search for other opportunities to invest or to have an income source. On the bottom diagram there, it says investment A and investment B. Investment A might give you a rising income, but in certain situations like COVID-19, where your investment might be badly affected, you might have an average income that does not drop due to situations such as COVID-19. So by not putting all your eggs in one basket, in other words, by making other investment in other areas, will reduce the risk of decreasing income due to situations such as COVID-19 or other situation that may bring a drop in income in one area of investment. Maximize your employment benefit. Employment benefit are something extra you get in addition to the salary. For example, you can see the diagram given below that illustrate various employment benefits. You also may have seen some are given the company's motor vehicle, and some may have their houses rent paid for by the company. These are addition to their salary or the benefits that they get from the working. Their main purpose is to retain good employers or well, employees, depending on their eligibility, they would get some extra benefit from the company. As an employee, try to take advantage of any employment benefit that may be given to you by the company so that you can maximize your saving. The second last one is pay attention to tax. Tax are levied on our income that we pay the government. An investment or enterprise activity will not be spared from tax. So also the business do pay taxes. So invest where you have tax-free return. So the avenues that we put our money in, all the income that we receive are not being taxed. Learn about the legal or tax requirement. And failure to adhere to government regulation will result in penalties. So you have to know which investment that you're making will result in you have to pay taxes, or those that are tax-free, that those investment that you're paying, the companies are being taxed, and all your income you get from it, you do not have to pay tax from it. The last one is always be prepared for the unexpected. Know the risk and the protection against this risk. For example, buying insurance cover. So you know what you're buying. For example, if you're buying a house, you should have insurance to cover for the house. By having an insurance cover, you're transferring the risk to the insurer, to the company, in case something happens to your house. So you'll not be left homeless in case you have a fire. So you have transferred the risk of that the house being destroyed to the insurance company. Unexpected events should not deter you from achieving your long-term goal. So the risk here is having unexpected events that will leave you stressed and leave you all your investment being destroyed. So there are two ways of doing this. Number one, having an emergency fund. Number two is to get the insurance cover on your investment. On the right hand side, there is an investment a research being done on saving for the unexpected. US adults were asked how they would pay for an emergency $1,000 bill. They said, so 41% say they will pay from their saving. So they have the saving to pay the $1,000 bill. And right at the bottom, 3% refuse to answer, meaning they don't have money set aside for these unexpected events. So those are the two areas that we can look at. One is to have an emergency fund. Number two, get insurance cover on your investment. Next is to understand the risk. Uncertainty or risk is involved in any investment. The key factor is to understand the risk in the field of your investment. The greater understanding one has on the risk, the lower the losses. For example, farms were destroyed by the cyclone and floods early this year. Yet 6 months later, these farms are thriving with healthy and fresh vegetables for the market. Farmers understand the risk associated with farming and the location of their farms. However, they also appreciate ways of benefiting from this risk. Usually, the higher the risk, the greater the reward.